My talk and my paper that is being posted in connection with this conference are about whether Pillar 1 can be stabilized. That is to say, whether any Pillar 1 agreement can be structured in a way that is likely to provide for reasonably consistent international implementation with countries abiding by the agreement over time. So Pascal emphasized how important stability was in his opening remarks. No BEPS 3. That's pretty much what Janine said too. My interest writing this paper is in order for its own sake. It's a kind of Burkean paper, okay? Accordingly, I'm not opining on whether any outcome of the Pillar 1 discussion would be normatively good or bad. I'm just asking what it will take to create order, and I'm restraining myself from making jokes about John Bercow. My conclusion is that stabilizing some version of a Pillar 1 resolution may be possible, but it depends on the substantive result of the negotiations. Some Pillar 1 ideas that are out there, including from OECD delegates and that have been hinted at in earlier sessions, okay, are actually impossible to stabilize. Those answers would create chaos in the medium term. Meanwhile, there's a ton of pressure to agree on a general political direction this year, and that political direction probably will implicitly answer some of the questions that determine whether or not Pillar 1 can be stabilized. I believe there are 6 questions that may be answered in the political resolution this year that determine whether Pillar 1 can potentially be stabilized or alternatively will collapse under its own weight. So if you have an interest in international tax order, considering these questions has to happen now and not after a general political agreement. To explore the issues, I started with 2 questions. First, what are the available stabilization mechanisms? And second, which decisions regarding the general approach under Pillar 1 affect whether any of those mechanisms can work? In talking about this, I have been surprised how few people know the answer to the first question. That said, Pascal knows, Occam knows, Sophie knows, Richard knows, Mike Williams knows. So for their sake today, I'm going to go through this part quickly, but it is the whole first third of my working paper, and I commend that material to anyone in the room for whom it would be of interest. It should be available on the Oxford Conference site and through SSRN. Briefly, though, just so we say something about it, there are 3 broad mechanisms for achieving international coordination with respect to Pillar 1. The first mechanism I label G20 soft law. By that I mean G20 mechanisms that are not unique to international tax. Most notably, G20 convenes a project followed by multilateral standard setting and then the use of peer review and other monitoring mechanisms. This is how the OECD did the Global Form and Automatic Information Exchange and a couple parts of BEPS. The second mechanism I'm labeling MLI+. International tax has some soft law tools that are really unique to international tax. For Pillar 1, the key MLI+ tools were alluded to by Sophie. It would be to modify the PE rules of OECD Model Article 5, the profit attribution rules of Article 7, the arm's length standard of Article 9, and provide for mandatory binding arbitration with respect to Pillar 1 through Article 25.5 or some successor thereof. Then there's the plus. That includes the ability to revise country-by-country reporting or otherwise create new competent authority agreements with new reporting architectures through the Convention on Mutual Administrative Assistance in Tax Matters, and thereby require jurisdictions to collect certain information from firms and automatically exchange that information. Together, MLI Plus and G20 soft law, to my mind, represent the complete panoply of relevant tools that the OECD has used in the past to accomplish various international tax objectives. So one question is, if the OECD were to use those tools and to their maximal extent, but invent no new tools, could any given Pillar 1 proposal be stabilized? This question also has been hinted at by Pascal and was just raised by Sophie, an MLI or a true multilateral. The third mechanism, of course, is a true multilateral. By that, I mean an agreement that includes collective obligations that cannot always be reduced into a bilateral set of state-to-state obligations. Parts of the WTO are set up that way. The League of Nations discussed such a treaty. The OECD talked about it through the 1963 model. It's been written by scholars and former officials, but the idea of tax sovereignty has always blocked it. And so for it to happen would require an especially strong push in favor of multilateralism at the highest political levels. The lawyers, I hope by now people understand the difference between an OECD and the MLI. The OECD MLI can't create legal obligations between a pair of countries that do not have a pre-existing bilateral tax treaty. A true multilateral treaty, on the other hand, absolutely can create such standalone legal obligations. But even among the 37 largest economies globally, 20% of the bilateral pairs don't have a tax treaty, right? So my analysis suggests that there are 6 structural decisions that can impact the ability to use any of the 3 mechanisms to stabilize the international tax structure. Importantly, some or all of them probably will be decided in the general political approach. So understanding the stabilization constraints is a 2019 issue, not a 2020 issue, okay? The 6 key decisions are: 1, whether or not to attempt to impose a distinction between routine returns and non-routine returns in defining the new taxing right. 2, whether or not to attempt to impose a distinction between non-routine returns associated with market intangibles and other non-routine returns. 3, whether or not to include traditional transfer pricing concepts as a component of the Pillar 1 solution. 4, whether or not to rely on consolidated tax base, unitary calculations. So global group concepts determined under tax, as alluded to by Richard. And 5, whether and how to use financial reporting concepts. And 6, whether or not to use a minimum tax architecture. On top of that, there's the one technical issue that does not need to be resolved in 2019, but does need to be resolved or else any Pillar 1 resolution collapses. That's the problem involving determining destination of sales of goods or services. I asked a question about that in the last panel. I'm not going to say anything more about it because I view that as a 2020 problem rather than a 2019 problem, okay? I think it's really important, but I actually think it's not the first thing you hit. So assume that somehow or other the destination problem can be solved, something I'm actually not sure about, but I'm prepared to assume for this talk, okay? That highlights the other 6 questions, and those questions are what my paper for this conference fleshes out. And with respect to those 6 questions, there is good news, there is bad news, and there is, well, ugly news. Let's start with the good news. If the Pillar 1 system avoids using any component of valuation analysis and the arm's length standard within Pillar 1, then the decision as to whether or not to impose a distinction between allocation of routine and non-routine returns may be flexible. In other words, as long as the ALP is left completely out of the determination of the amount of Pillar 1's new taxing right, it may be possible to stabilize things regardless of whether governments want to include only non-routine returns or all returns in the reallocation. To use Richard's language from the last panel, you can use a proxy to isolate the residual and maybe it's still stabilizable. But the price of this advantage is some double taxation or some double non-taxation almost every time. But in contrast, I've heard a number of people suggest that administrability turns on the choice of all returns or just non-routine returns, and I initially had that instinct too, but I think it's not right. The real issue is leaving the arm's length standard totally out of determining the Pillar 1 amount. The second piece of good news is that the Pillar 1 compromise, if it's based on a minimum tax architecture, gains some flexibility. The reason is that minimum tax systems relieve pressure on any version of Pillar 1 relative to a final liability rule. And I know that talking about it that way is a little confusing because people usually use the minimum tax language in the context of Pillar 2, but it's the clearest way to articulate it, right? If you have a minimum tax structure for Pillar 1, it creates incentives for MNCs to build transfer pricing structures that generally align with the new Pillar 1 taxing right. That means the Pillar 1 rules do not have to be tested every time. That's a significant advantage in dispute resolution. You want to do it that way. You don't want a final liability rule. Okay, now the bad news. So number one, pure G20 soft law. A peer review system just can't stabilize Pillar 1. The bare minimum is the most extensive use of the MLI tools imaginable. In other words, every tool the OECD has ever deployed before used to its maximal extent and beyond. This is obvious to OECD tax folks in the room, but I've learned it's not obvious to G20 Sherpa types, so I said it. The more important piece of bad news on this is that any system that mixes any new taxing right based on any destination principle with traditional transfer pricing concepts cannot be stabilized. Even a true multilateral treaty cannot realistically solve that problem. If Pillar 1 incorporates any traditional transfer pricing within Pillar 1, for example, by using the arm's length standard to determine routine returns, the system becomes irreparably unstable. The problem is worse if you try to do it with an MLI plus approach than in a true multilateral treaty, but it's unsolvable either way. You know, if that option is not rejected in the general approach, the project is doomed to failure. Can't do it. So far, I've said do X and all is lost, do Y and there is a chance. But how about the it depends part? The it depends applies to the issue of what Richard called the global group approach, to the issue of unitary calculations to define the new taxing right allocated to market jurisdictions. These are possible, but they are not amenable to being stabilized using the MLI plus approach. If the Pillar 1 compromise includes meaningful unitary elements, it will require a true multilateral treaty to stabilize. I think Sophie said that too, actually, but I'm not sure. On the other hand, and that hardened me, on the other hand, a general approach that nearly eliminates reliance on unitary elements, so relies almost entirely on financial and managerial accounting measurements, just might be stabilized with MLI plus. Might. Even here, it's better to have a true multilateral treaty, but I'm not prepared in that case to say that a true multilateral treaty is absolutely required to stabilize a system that avoids all unitary tax calculation components. Okay? And some people would think that's a huge advantage, and some people would say that's a very slim read, and I don't know what different people in the room think. Why is that ugly? Okay, well, one important reason that's ugly is that if the chosen Pillar 1 general approach relies on financial reporting, the policy questions that arise out of relying on financial accounting to determine tax results have to be addressed. And that's true regardless of whether we have an MLI or a multilateral treaty. The three most important questions, I think, revolve on one, the potential for residence jurisdictions to change accounting principles in light of the Pillar 1 agreement. For instance, recall that when the US FASB was going to allow stock option expensing the first time, Congress stopped it. Two, the level of comfort that market jurisdictions can achieve with private sector financial auditors in residence jurisdictions determining the amount of tax revenue being allocated to market jurisdictions. So recall, every US MNC is audited by a US accounting firm. The accounting firms are single global entities in name only. Is France prepared to have Deloitte US make determinations to decide how much income tax revenue a US MNC owes to France? I don't know. Third, the concern that will be raised by financial regulators with book tax conformity that makes financial accounting standards rather than legislated tax accounting rules primary. Will FASB and IASB accept this? Or will they fear that it begs political interference in their highly cherished self-regulatory system for the accounting profession? And here I mean the real accountants, not the tax people at accounting firms people in the room are familiar with. I would like to point out also that all three of these questions are kind of orthogonal to the traditional book tax accounting debate that, for instance, Mahir has participated in, okay? They are different. The simplest, rough, justice-based approaches for Pillar 1 might be implemented using the MLI plus approach. That is to say, a combination of tools previously used multilaterally by the OECD in the international tax arena, but they have to be remarkably simple. They cannot do business line by business line. There's a million things they can't do, okay? Even then, however, it would be less stable than implementing the same Pillar 1 concept through a true multilateral instrument. One important reason a multilateral treaty is preferable to the MLI plus approach is that the MLI plus approach is really ill-suited to deal with MNCs with losses and to identify surrender jurisdictions. And, you know, Georgia tells me that about 20% of MNCs have negative EBIT every year, okay? So it's not like a trivial question. The more the compromise for Pillar 1 starts adding in additional levers, unitary type features, the more the MLI plus option simply is not an option. A true multilateral treaty becomes the only way. And that requires a level of multilateral cooperation that has never been previously achieved in international tax affairs. Alternatively, if you decide that you want the MLI plus approach, many options are taken off the table. Realistically, they cannot be stabilized. And so if you don't think you can get a multilateral treaty, your road becomes extremely narrow, and political people who think they're coming up with nice answers may just put you in a place where it's doomed to fail unless they understand the implementation challenge. That's my talk.
Thank you, Itai.